Hey, welcome everyone. Tom from Park Avenue Trading. In this video, we're going to go over some classic moving averages by the founding father of actually moving average crossover systems, Richard Donchain. I guess he was Armenian, so Paravinch basis for all my Armenian friends out there. It's the only thing I know. But hey, if you like what you see, please like and subscribe. Don't forget to ring the bell so you don't miss any of my amazing content that I put out. But anyway, let's get on to the lesson at hand here. As you all know, I profess that I'm not a big proponent of moving averages. I think that they're lagging indicators, and I get a lot of heat from that from some people. You know, they're like, "Oh, you have no effing idea what you're talking about. They never fail." Give me a break, man. They fail more times than not. And I'm going to prove it in this little video. Now, I have nothing against people that use moving averages. There's nothing wrong with that. If you use them and you're successful with them, more power to you. Keep on using them. I'm more of a price action guy, and I'm going to show you a little bit about what I mean by that. When you see all these lines up on the screen, those are my trend reactionary numbers that I just calculated for the British pound, Swiss franc, for a client that wanted these, and I did the calculations for him just about 2 weeks ago. So these are good, fresh trend reactionary numbers, and you can write them down, and you could basically see how they work over, you know, the course of the next month and a half, 2 months. Okay, so they're there for you. It's written in stone for you, and this is actually what I do is I calculated these trend reactionary numbers going back to November of 23 and extrapolating wave measurements forward, because that's what trend reactionary numbers are. Now, this is not about my trend reaction numbers. This is about Richard Donchain and what he did. Okay, so we could say that Richard Donchain is one of the true elder statesmen of commodity trading. Now, he didn't trade Forex because he traded back in the 1960s, and Forex didn't exist until good old Tricky Dick took us off the gold standard, and the dollar began to float. So thank goodness for Tricky Dick, Richard Nixon, because I would be probably trading soybeans or something, or live cattle, and God forbid we're trading live cattle. I mean, I have yet to come up with anything that works with live cattle. But anyway, so I digress. So he started trading using a system back in 1961. Excuse me one second. And what he did was he came up with moving averages as a way to smooth data out. And it's often used, actually it was used at that time with raw price data, such as data on the close of the market itself. And you know, moving averages are also useful in constructing oscillators, and George Lane was the first guy to come up with oscillators based off of Donchain's idea here of the 5 and 20-day moving average, and he came up with percentage D, percentage K, stochastics, and good old Wells Wilder had something based off of this stuff called relative strength index. So those common oscillators that you see on every trading platform today actually came off of this one idea of Richard Donchain. So the purpose of the moving average is to measure the trend over a time period, and you can, and over the time period actually that you're using, that you're collecting the data on. Now, a price above the moving average suggests upward trend. A price below the moving average suggests a downward trend. Now, Donchain selected two moving averages. One was a 5-day moving average, and which represented a week at that, for that time, you know, and one representing 4 weeks, okay, or 20 days worth of data. So the system was always in the market, and it would go long if the 5-day moving average crossed over the 20-day moving average, and it went short when the 5-day moving average crossed below the 20. So the system was long when the short-term trend is up, and it tried to anticipate intermediate term trend changes with that 5-day crossing the 20, and it, you know, it was short when the 5-day moving average crossed below the 20, and it does very well, you know, in trending markets. But when markets are just like dawdling around, okay, you're going to get caught up with this thing, and you're going to get whipsawed, you know, and you're going to give back a lot of money that you made when the market was doing well and trending. Now, some people say, well, I just want to use it. I'm just going to use it when, you know, I catch good moves. You can't do that because you can't optimize the system. There's no way that you could say that when you go back in time, like, well, I would have bought here. I knew that the market was going to turn and the 5-day was going to cross the 20. You're just playing with yourself mentally. You know, you're playing mental head games. You got to go back and you got to test the system, and you got to make sure. You got to take all the data, and what I had somebody do, I didn't do it. I'm really lazy, so I actually paid somebody to do it for 3 years worth of data. I'm going to give you that data at the end of the video so you can see for yourself, and you can go and test it yourself if you want, you know. So on average, moving average crossovers lose money, although they can be very profitable at times. Now, the turtles had a better system, and there was only price action based. So I'm getting back to my price action theory here, that price action for me is basically, you know, the king of everything. These crossovers being lagging indicators can chop you up. But anyway, the drawdowns really could be horrendous with this thing. And they really just chew up everything that you made when the marketplace was really trending strongly in one direction. So let's get on to the presentation itself. What I have here is TradingView, and with TradingView you could go back and replay a market. Okay, so the yellow line in here represents the 5-day. The blue line represents the 20-day on the closes. You see, on the close. Okay, so this marketplace, now we have to always take into consideration that can you see the divergence between the two moving averages right now? Obviously, the acceleration is very quickly here, so the 5-day closes are going down really fast because the market's in a downward movement right now. Okay, so when we got this signal up here, okay, you didn't really get the short signal until probably right here on this bar, which was a low of 109.85. Now, the marketplace was, the moving average system was saying stay short, okay, because the 5 didn't cross the 20. So if you went short of 109.85, you had to go down to a drawdown, you know, period of 110.90. So it's 100 and some odd points. No, not a big deal. But for a short-term trader, you know, a person that doesn't have the chutzpah, you know, you could say, oh, F, I'm screwed in this thing, you know, and close out. Okay, it takes, you know, you really need to feel comfortable with this system. So let's just start moving it forward. So it got you short, and let's say you had the balls to stay in it, and the marketplace is moving down. So far you're short at, say, 109. Let's say 109.80. Okay, or let's say 109.9. Let's say 110. Let's say you did 110. Okay, 110 the figure. Marketplace came down to 106.30. Excellent, right? So it's 400 points, 400 plus points. So let's start trading. Let's start the scenario from here. Okay, let's get it moving. Okay, so now you're short. Okay, and now you had 400 points profit. Now you're starting to give back some. Yeah. Okay. Market got. Oh, let's pause it here. Let's pause it. Market basically got you long. The crossover actually happened on this bar. So 109. So you got short at 110, and this thing is buying back at 109. So you made 100 points overall over the 400 that you had. But you, like I said, you can't go back and optimize and say, well, I definitely would have gotten out over here. You can't do it. You're waiting for the crossover, because this thing captures the biggest moves in major trending markets. If you were to put this thing on, you know, say sterling yen recently, when it was, you know, 208, when it was the high, 210, and you ran it, man, this thing made a, you know, and we went down to 180. It stayed short. It did catch that move. I'm not going to say it didn't, but price action caught it as well. But anyway, let's continue on. Let's play it forward. So it got you long here right now. Okay, so you're making some money still. All right. Now, I'll fudge it and say that at this point you didn't do anything, all right, because it really didn't cross over. They kind of met and kissed each other. But believe me, when this thing it's not completed and you don't know where it is, there's a separation in it, and it touched, and that's when you start to psychologically second guess, like, what the fuck is going on, right? I mean, like, what, you know, what is this? Anyway, go on. So we're still long, like 108 something. Still doing well. Okay, the trend is still up, still following it quite nicely. Still nice, still nice. Let me move this down. So it got you out here, which is excellent. Got you short. Market turned up, it got you long again. I can't tell. Got you short, so you got a little bit chopped up over here. You got back probably what you lost there. It actually met. It's getting you short right here again. It got you long on this bar right there. Now this is daily bars, okay? This is always applied to daily bars. If you applied this to anything else, there's a lot more whipsaws. So just so that you know that. This is daily bars. And here we go. Basically you were long, and it got you short on this bar, which is a nice move down. And that's it. That's the end of the sequence. And here we are. Okay. So overall, you would have made money on this period so far. I don't know how much. I didn't calculate it. But hang on. I'm going to pull up the statistics for 3 years. And it doesn't have this cross currency in it. It's got just the majors. Okay. So hang on one second. Okay. So here's 3 years worth of data using the 520 moving average by Richard Donchain. Okay, and dollar yen. All right, the number of closed trades. I don't know how he got only 67, but maybe this was a 2 year. It's 2 or 3 years worth of data, but 67 trades, staying in the marketplace. All right, constantly back and forth. 67 trades, profitable trades 20, percent profitable 30%. P&L, negative 75,650. Average profitable trade, 3,179. Average loss, 2,962. Maximum drawdown, 89,375. Average profit, negative 1,129. Sterling, yen, 56 closed trades out, 21 profitable, 37%. As you can start seeing that they're all around like 37, they're like 30%, okay? P&L, 16,440. Average profitable trade, 3,404. Average loss, 1,572. Maximum drawdown, 15,619. Average profit, $294 a trade. Okay, so $294 a trade over, let's say, 3-year period. I think it's 3-year period. Euro yen, 58. Closed trades, 22 winners, 38% win-loss ratio. P&L, 14,775. Average profit, 1,794. Average loss, 686. Max drawdown, $7,425. Average profit, $255 per trade. Okay, 3-year period. I threw some commodities in here to act like it was a portfolio, and I put that live cattle in there. Live cattle is nasty. Soybeans, closed trade 60, 22 profitable, 37%. P&L, 3,338. Average profit, 1,676. Average loss, $883. Max drawdown, 12,000. Average profit per trade, 56 bucks. Live cattle, 52 closed trades, 13 are profitable, 25% profitable trades. Okay, now why I'm stressing these numbers is because this is really hard for traders to take. When you're only winning 3.8 times out of 10, it's really difficult to take, especially when you're waiting out that moving average crossover. So anyway, 25% win ratio, $13,200 P&L loss, 1,060 bucks average profit. Average loss is 692. Maximum drawdown, 15,344. Negative $254 on a trade. All right. So with that being said, I'm going to quickly go over price action. Now, these numbers that you see on the screen, these levels, were good since way back November 23. I extrapolated, went extremely long term with trend reactionary numbers, and I'm just going to go over quickly, where these things would have got us short, where they got us long. There's a way to trade these, and I give these to you. So if you want trend reactionary numbers and you want them for a 3-month period or something, leave it in the comments. Say you want it for sterling yen, you want it for euro yen, you want it for euro dollar. I'll do them for you, no problem. And I'll basically show you how they work, okay? At this top right here, okay, the trend reaction numbers were telling us that this was basically resistance. And how I use these, I use them in a certain way. I say, okay, I'll basically risk 100 points on these things. So if the marketplace is coming up towards this resistance level at 117.07, and the high was 116.77. Okay, I would basically sell this thing if it moved away 45-50 points away from this top. So let's say I go 50 points from 77. I'd be looking to sell 116, say around 20, 116.20. I would have got short at 116.20 right here. Now, the marketplace, I would have gotten in, and the marketplace would have went up against me to 116.55. Not bad. It's only 30 points. It's not like on a moving average 200 points away or 180 points away. It's only 50 points away. Plus, I know that I'm stopping out above like this 117 02 level, I probably would stop it out at 117.13. I'd stop this out at 117. Wherever I went short, 117. I went short at 116, say 20. I would stop this out like 117.20. So I'd lose 100 points. But what I'm going for is the break of the TRN down to the next TRN. Now, if you notice how this marketplace reacts. Now, I didn't make this shit up, all right? I mean, if you know me, it is what it is. I've been giving trend reaction numbers out for a long time, and they're just uncannily accurate. I mean, I'm shocked sometimes at how accurate they are. So, for me, the price action is much better than the crossovers. Now, that's just me. If you like the crossover, if you know you want to get short here, okay, and then you have to go through that before, you know, the market basically crosses back over here and gets you long, where you basically got in at the same price that the thing is turning around at. Or would you rather, okay, I won't cherry pick anything. Here's a downward movement. I'm close to this 111.29. What's the low here? It's kind of far away, but I would have taken this if on a break and close above this TRN, which it does, and I would put my stop down here. So there's a few methods I use. Considering I was too far away from this one, I would have said, okay, we came down here, we have support, we're in a buy envelope, okay, that's really my safety valve, stop to get the hell out of this thing. Marketplace basically closes above it. Okay, the queen says yes. The next day, it continues, and the marketplace moves right up. I'd rather be getting long right around 112, say 80, okay, with a stop at what's this low here? 112.16. I would put a stop at like 111, probably like 70. I wouldn't, no problem there. And instead of waiting for this crossover to get me long up here. So I'm in the train way before the train moves. So I'll leave you with that. Check out the numbers. They're all here for you. You can get it. Let me crunch it all down so you get them all. Those are all the trend reaction numbers for British pound, Swiss franc for the time being. There are some lower ones if you want the lower ones below 105, and there's one at hang on. There's one at 103.78 on the low side, 102.23, 1.0068, and then the Mac Daddy 0.9949. The upper level, hang on, I'll give them to you in a second. Extra upper levels above 121.42. We got upper level at above 121.42. It jumps to 123.32. Then it starts to contract a little bit, and that's the way waves do happen. You got 124.81 and 125.35. So again, I'll leave you with that. Please, if you like what you see, leave some comments. Tell me what you want me to go over. I want to interact with you guys. Don't forget to go over to Park Avenue Trading. Get yourself a free technical ebook. It's not like any ebook you've seen out there. It's not, you know, rehashed bullshit. It's really good trading techniques that you could use for trend line breakouts, for pivot points, for even trend reactionary numbers. It's really good stuff. Okay, give some really good mechanical rules. Look forward to seeing you in the next video. Cheers.